Alright, so welcome to part 2 of the Supply and Demand Universal Strategy series. And if you haven't already, don't forget to join the Discord. I give out free signals temporarily because I don't know how long we'll be doing that for. But take advantage of it now. I already have someone that's been making pretty good money with the signals. So don't miss out on this great opportunity. Alright, so without further ado, let's begin. Okay, so we are going to talk about entry confirmations. I will essentially be giving you different ways to enter a trade. I have started it off with the most riskiest way to enter a trade down to the more safest way to enter a trade. Now, nothing is fail proof, obviously, so take everything with a grain of salt. Do your own research, back test yourself, see how you like it, see what fits best for you and your psychology. Hopefully you can make your own trading plan using these different entries. So let's begin. The first one being is limit order style. I know a lot of people love trying to enter trades with a limit order. I mean, who doesn't, right? You get those really nice entries, but I want to go over the pros and cons of this. Pros: you have price control. A limit order guarantees that a trade will be executed at the specified price or a better one. This allows traders to better control the prices at which they trade. Number 2 is cost control. Limit orders ensure the trader does not get a worse price than they expect, right? So it's better than entering at a market order because you never know, right? When you want to enter the trade, maybe MetaTrader takes a little bit too long and price ends up taking off a little bit more than what you expected, right? Next is precise entry. Limit orders provide traders with a means of precisely entering a position without any confirmation, especially on the higher time frames. I recommend using limit orders on a higher time frame rather than lower time frames, just because when you're on higher time frames, you require a little bit less confluences to enter a trade, and it's a little less riskier. And number 4 is price improvement. There's a possibility of price improvement when an asset gaps from one day to the next. So basically, if you get in on a limit order and then the next day there's a huge gap in price, you'll notice that you got in at a really good deal and you made a ton of money. But let's be honest here, it doesn't always happen. Now, the cons is no execution guarantee. While the price is guaranteed, in other words, while you're guaranteed at getting in at a better price, the filling of the order is not. So sometimes price can move so quick at your point of interest or where you have your limit order that it may not get filled on time, right? Sometimes you'll see a quick spike in price, like let's say during news, and it was just so fast that it did not register on your broker. So that can always be a problem. If the asset does not reach the specified price, the order is not filled and the investor may miss out on the trading opportunity. So that's another problem. Let's say you have a limit order set at a certain area. You're waiting, and then you realize price never actually reached, let's say, that order block or that supplier demand zone, and you're just sitting there crazy mad, asking yourself, why the heck didn't price touch my order? That can happen. That's a really big problem faced with limit orders, but I've already showed you in a past video how you can try to sort of mitigate that. Number 2, obviously, missed opportunities and fast moving market conditions. Limit orders can result in missed opportunities due to how fast price can react. Number 3, longer execution time. Unlike market orders, limit orders usually take longer to execute due to spread. So just because price touches your order doesn't always mean that it's going to get filled, because sometimes spread has to be accounted for. So I want to show you a quick example on how you can use a limit order and how you can benefit from it. Let's jump on the charts real quick. All right, here you can see I have my order block marked out and my limit order set here. Now you might be wondering, why do I have my limit order marked out? Well, because there was a break of this high right here right? And that high was broken because it was from this order block right here. Let me zoom in for you a little bit. This is the order block from where that high was broken, right? If it wasn't from this order block, price would not have gone up. So this is a start of where price went up. So that caused our first break of structure, or we could just call it our possible change of character. And then it was confirmed from the pullback here. And then we had another break of structure up here. Okay. And now all we got to do is wait for price to tap into our limit order. And this is going to be our main target right here. That will be our take profit. So we just let price play out. We let it sweep all this liquidity. Now here's the thing right here. Hold on. Actually, before price taps in, I wanted to show you something. A lot of people, and this is on the 5-minute time frame, by the way, a lot of people just by seeing this would have gotten desperate. Why? Because they saw price reject so fast with this candle right here. A lot of people would have already entered, and next thing you know, they would have set their stops just under this candle, right? And you would have gotten in at a bad time. That's why it's very important to be very patient. Okay, sometimes price reacts that way because it took out a lot of liquidity and it's just a reaction from it. So you got to be patient. All right, so we'll let price do its thing. Price taps you in. Nice, beautiful rejection. You get in at an amazing price, and your risk to reward ratio is amazing, right? And TP is hit. That is the most beautiful TP ever, right? Now the problem is that there's also a little issue with you maybe even getting stopped out before price goes into direction, right? So sometimes price can dip through your limit order, right? Maybe sometimes it'll dip in through it like this, and then it'll head in the direction that you wanted to in its original intended direction. That's another reason why I wouldn't recommend entering with limit orders too much unless you're in a higher time frame, right? But even then, it's still risky. All right, so just keep that in mind. Now we have candlestick patterns. The pros is visual clarity. Candlestick patterns offer traders a visually intuitive depiction of market sentiment and trends. Second is widespread recognition. These patterns are universally acknowledged, making them accessible and comprehensible to traders of varying experience levels. Number 3 is optimized timing. Traders can finely time their entry and exit strategies through effective pattern analysis. Number 4 is identify support/resistance levels. Candlestick patterns can help traders identify potential support and resistance levels in price action. Sometimes you'll have a candlestick pattern and maybe you'll see that it will match with a certain level of support or resistance near your demand zone or your supply zone, which can give you a more of a confluence, right? You'll feel more secure in entering that trade. Now, one of the cons is subjectivity. Interpreting candlestick patterns can be subjective, potentially leading to misinterpretation by traders. Number 2 is challenges in volatile markets. Sudden price fluctuations in markets can trigger false signals from patterns. Number 3 is higher false signal risk. Since candle patterns can be useful for short-term day trading strategies due to their speed, however, their disadvantage is the higher false signal risk compared to multi-candle patterns like a 3-line strike or 3 black crows. Anything that involves more than one candle would be considered a pattern, right? So I would recommend, if you're starting off with candlestick patterns, to use the ones that I recommended, like the 3-line strike or 3 black crows. Now, a pro tip is a lot of these patterns work well on the higher time frames, like a 30-minute, a 1 hour, 2 hour, 4 hour, etc. And a few of the other ones that I also use is the first opposite candle you see as soon as it touches your supply demand zone, an engulfing candle, which is still one of my favorites, especially on a higher time frame, the 3 inside pattern, a hammer, and a doji. So let's jump on the charts, and I'm going to show you a quick example. I will link a description to an indicator that I'm using for this candlestick pattern indicator. As you can see here, price reached my supply zone, barely taps into it, right? And I'm on the 1 minute, by the way. I see the engulfing candle, bearish engulfing. I get in on that candlestick pattern and I target this set of liquidity. Now, another thing that a lot of people might not like is you might not get as good of a risk to reward as you usually would entering with a limit order. So that's a little bit of a trade-off, but it's better for safety because you just never know when you might get tapped out and you end up losing some money, right? So let me show you an example of what that would look like. Okay, perfect. So here, right, let's say you had a zone right marked up here for whatever reason you wanted to mark up the zone. You would have gotten stopped out right here, right? You see that wick? You would have gotten stopped out as if instead if you would have entered over here, right? So if you would have entered at least over here at this doji, you could have put your stop loss just under this fair value gap, right? You won't have to put it in under that order block if you don't want to, but you could set it just under this fair value gap or maybe a little bit lower, and you could have targeted maybe this set of liquidity up here, or if you are like me, that is a little more safer, you can go for a 1 to 2. In this case it would be a 1 to 23. So 1.23 would have been your risk to reward, but you get the picture, right? So sometimes candlestick patterns can help avoid that. Or like I said, you could have entered at the first opposite candle, but this would have been a little bit more safer. Practice it, open up some charts, draw up some zones, and give it a shot. All right, so now we have a breakout of zone. So the pros is 1, clear indication. Supply and demand zones provide a clear indication of where large numbers of buyers and sellers are likely to enter the market. Number 2 is identifying turning points. This strategy can help identify potential turning points in the market. The more price closes outside the zone. Number 3 is versatility. This strategy is applicable across various asset classes, including stocks, commodities, Forex, etc., making it a versatile tool for traders. Now, let me make this more clear. Everything that I'm showing you can apply to any market. It doesn't have to be just this, okay? I just want to make that very clear. Now, another thing is that the bigger the candles are in terms of rejection, when it breaks out of the zone, the higher probability it can be. Now, the cons is you can have false breakouts. There can be false breakouts leading to potential losses if a trader enters a position too early or too late. Now, to mitigate that, you want to get a risk manager. If you're on a MetaTrader still and you're using a risk manager or a lot size positioner, you can still risk 1% no matter how big your stop loss is. Number 2 is increased risk. There's a higher risk due to increased volatility. Now, sometimes if price is moving too fast or in big quantities, you can either get in a little too late or price can reject. Even if it does break out of that zone, it could possibly still pop back up and then go down. That's another risk, but that's a risk regardless of any other entry you take. Next is there can be limited entries. Sometimes price can reject too quickly and far, which can cause you to miss an opportunity or create bigger losses when placing your stop loss too far. Sometimes price can reject way too quickly and with so much momentum that you'll tell yourself, you know what, price has already left, it's already too close to my next take profit or to my first take profit, there's no point in me entering. Okay, but I'm going to show you a quick example of how a breakout zone can be used. Okay, so I marked up my supply zone here and I'm using Bitcoin for this example because hey, you can use this on anything. And as you can see here, price tapped into it, and as a matter of fact, this was actually the first candle where it broke out from. Nice price momentum. I could have gotten stopped out here because of spread, but thankfully I got in here, and since I already saw that price rejected off of this order block, I am more than safe and more confident that I can put my stop loss above my zone, and I can either target my first set of liquidity, which is here, here, or here, and lastly here. All right, and this is on the 1 minute time frame. So you can use this on anything, guys. You can literally go on any chart, open one up and try it out. Now, I don't really use this too much. You can use this, but I wouldn't recommend it because sometimes, yeah, price can reject pretty slow from this order block, and as price is rejecting and rejecting, there can be times where out of nowhere it'll just reject super fast and it'll take off. Like it could look something like this, right? Or maybe on a higher time frame the candle could be a lot bigger and you thought, well, price was moving slowly outside of the order block, why didn't it move, you know? And sometimes you can even second guess yourself because of how slow price can move or how fast it's moving. So if you're going to use this, try it on a lower time frame, mainly anything from like the 5-minute and lower, but outside of that I wouldn't really recommend it too much. But it's up to you, and who knows, maybe a wire might work best your way, right? So let's move on. Next is Fibonacci tool. So the pros is identify support and resistance levels. Fibonacci retracements can help traders identify potential support and resistance levels in price action. Number 2 is strategic entry and exit points. Understanding how to apply the Fibonacci sequence can be a game changer in your trading strategy. It can help you identify better entry and exit points. Number 3 is buy/sell levels. The system plots the buy/sell level on the current price action. Now, in terms of identifying support and resistance levels, you can find some really good support or resistance levels with your Fibonacci zones, and they could probably align with any of your order blocks. And actually here, before I zoom in on another example, you can see that on the 0.618, you can see how price has rejected from it, causing it an area of support or resistance, however you want to label it. I would say it's more of a resistance area. You can see that here could have been an order block somewhere in this area, or maybe this was the order block, right, that you could have used. It all depends on how you see it and how you want to use it. Another thing is that you can use these Fibonacci levels as your take profits. So you can actually target your take profit zones if you can find any with these levels. Now, the cons is subjectivity. The use of the Fibonacci retracement is subjective. Traders may use this technical indicator in different ways. Those traders who make profits using Fibonacci retracement verify its effectiveness. At the same time, those who lose money say it's unreliable. So you might say, oh, it works well for you, but it doesn't work well for me. Therefore, it doesn't work. Guys, it all depends on how you use it. I might use mine differently. I might set my Fibonacci from the top of the range to the bottom of a range differently, right? Number 2 is additional indicators needed. You may need to apply other indicators for further signal confirmation. That is why we're using order blocks, right? And that's why we're trading with the trend. Number 3 is limited signals. This strategy is only effective to indicate corrections and reversals and doesn't provide clear signals as other strategies often do. Now, don't get me wrong, you can make a perfectly well and functioning strategy simply using a Fibonacci tool with supply and demand. I mean, I'm pretty sure Doyle Exchange has talked about this in one of his videos where he says he's only used a Fibonacci tool applied with some supply and demand, right? So anyways, I'm going to show you a quick example of how you could use this in the markets. Okay, so I've marked up my Fibonacci tool from the bottom of this range to the top, and if you want to copy my levels, you can do so here. You can copy these levels and these will be your take profit zones, and these are all the different take profits that you can take, right? But I'm not going to show you that because this is just recent price action. Maybe I'll show you in a little bit. But as you can see, my order block aligned with my Fibonacci level, the 0.9 level right here. I waited for price to reject off of the order block and the Fibonacci level, and then I entered at this first rejection, targeted first set of liquidity, which was right up here, and that gave me a 1.93 risk to reward. Now, I said I was going to show you how you can use the Fibonacci as your take profit level. Let's see, you could mark it up from, let's just say here to here. Now, let's just say you decided to use this area, this order block, I don't know, it's part of your demand zone, right? You could have entered from here, and then let's say you entered at this order block, I don't know, and then yeah, you could have targeted this one right here for your first TP, your second, third, fourth, fifth, right? And it's up to you. It's up to you and what you've back tested and what you feel comfortable with. Also, you have to read the momentum in price action. But very effective tool. Try it out, see if it works for you, and if it doesn't, who knows, maybe you might want to try something else, right? But these are just things you can use in any market trading condition. Every now and then I'll still use my fib tool. It's really useful. All right, let's continue. All right, everyone, so I actually wanted to edit this part of the video because I think there's a few little changes that I've made. This is one of the changes, and then I believe there's another tool that I've added for confirmation. And as you can see, I even added letters for better reference as well. So real quick, I'm going to go over the first example of an inverse fair value gap and how you can use it. And so I'm going to need you to pay very close attention because, like I said, I've added an extra little confirmation here. So first thing is, when you have an inverse fair value gap, you can actually use it as another point of interest. So let's say you have some liquidity down here, right, and you're looking to enter into a buy. As you can see, there's a inverse fair value gap with an order block. What you can do is wait for price to tap into that inverse fair value gap with an order block, and you can use that as a high probability setup, and you can enter just off of a limit order or from the first candlestick that rejects towards the opposite end or towards the reversal, right? So that is one way that you can use it. The next is, let's say price just inverts a fair value gap. Once price inverts it, as soon as it inverts it with a strong candle, the bigger the candle, the better. Okay, just remember that. Once it inverts it, you can enter off of that inversed fair value gap, enter off of that candle that caused the inversion, put your stop loss either under the recent low or under the bodies, wherever you feel more comfortable, and then you can write it to your next TP. So that is one way that you can use inversed fair value gaps. Okay, so for this next part, changing state of delivery. Now, if you guys don't know what change of state of delivery, then I suggest you do some YouTube searching. If not, I probably have already made a video on this. If I did, I will link it down in the description below. So when it comes to changing state of delivery, you can use the close of the body here, right? So once price closes over the body, right, you're good. So as soon as we get that close, you are good. And it doesn't have to be too big, but the bigger the better. The less candles it takes to close over these consecutive candles, the higher probability becomes. So basically, the faster, the quicker, the more efficient price closes over the body, the better it is, guys. Okay, now if the candle body closes over the wicks as well, whether it's on the first attempt or the second attempt or at any point, then that's even higher probability, right? So let's say instead of the body of this candle closing over here on just the body of this bullish candle, instead of it closing just here and it decided to close over here, right under that wick, then that would have been even better, right? Even way better. Kind of like how this candle closed over this bearish candle right here, right? So over here, see how that wick is there? Once this body overlapped this wick, that is higher probability. Now obviously this is not the same color candle, but I'm just using it as an example. Okay, so that is how I would prefer that you guys trade with changing state of delivery if you do decide to use changing state of delivery. But remember, guys, it has to tap into a POI or your supply or demand zone. Okay, all right, cool. All right, so pay very close attention to this. Okay, this is very important because it's gonna get a little technical. All right, so market structure shift. Pros: trend reversal identification. Market structure shifts can help identify potential trend reversals, which can be a powerful tool for day traders. 2 is market sentiment insight. Market structure shifts represent a collective shift in market sentiment, where the underlying fundamentals or trader perceptions have changed, driving the market in a new direction. Number 3 is entry and exit points. Order blocks, fair value gaps, the breakup structure, and RSI readings can help traders find entry and exit points when a market structure shift is identified. Now the cons is displacement requirement. Identifying a market structure shift without clear displacement is a common mistake among traders. All displacement is a break of structure with some strong bearish or bullish candles causing a gap. That is at least the way I have been taught to. Number 2 is false signals. Like any technical analysis tool, market structure shifts can sometimes give false signals leading to potential losses. I've talked about market structure shifts in the previous video, check that out, but it can happen, especially on the lower time frame. And number 3, it requires experience. Understanding and correctly interpreting market structure shifts require experience and a good understanding of market dynamics. Now, on this part, pay very close attention. All right, the first one, and these are just 3 different options. Okay, the first option is you enter as soon as there's a break of structure. Let's say you have your supply zone, you see there's that first break of structure right here caused by this candle. You enter that candle, set your stop loss at that recently created high or fractal high, and then you target your next set of liquidity, which could be somewhere down here. The second one is set a limit order on the fair value gap. So I don't know if you can see my order right here, my little risk to reward tool. You can set a limit order on that fair value gap, so that way as soon as price touches that gap, you are entered into that trade, and then you target your next take profit, or you can enter at market order as soon as price touches that gap, right? It doesn't have to be a limit order. You can just wait for a market order, wait until price taps into it, and then you can enter. And 3 is wait for price to enter the fair value gap and then reject from it. So you start off again, break of structure, you see a retracement into the gap, and instead of entering from the gap as soon as it touches, you wait for price to reject from that gap. As soon as you see a price reject from it, whether it's the first bearish or bullish candle, depending on what trend you're looking at, but in this example, it would be the first bearish candle, which is this one. You could either enter from that first bearish candle, or you can wait for price to exit that fair value gap, which would be this candle right here, right? You would enter from there. There's so many ways that you could do this. The third one would probably be the safest one, right? Obviously, but you can't have it all. Sometimes you can get in at a really good price. Sometimes you can't. Sometimes price takes off a little too quick the more you wait. It really just depends on what your backtesting results give you, how patient of a trader you are, etc., etc. Practice it on a chart. See how you can identify this, how well you are at identifying market structure shifts, or some people call it micro structure shifts. Whatever. Point is, give it a shot, check it out, and let me know what you find. Using a double break of structure. So the pros is trend direction. Double breaks of structure can provide traders with a clear indication of the trend direction and potential trading opportunities. 2 is trading opportunities. There's potential for substantial profits during breakouts. Early identification. This strategy offers the opportunity to identify trend reversals more securely. Number 4 is increased volatility. Increased volatility can lead to enhanced trading opportunities. Now, cons, false breaks. False breaks can occur, leading to losses if a trader enters a position too early or too late. Number 2 is the higher risk. There's a higher risk due to increased volatility. So just how increased volatility can be good for you, it can also be bad, because sometimes price can break out a little too strong from the first break of structure or the second, and then you miss out on your trade. And number 3 is bigger losses. If you are trading with a fixed lot size, you might lose more capital if your stop loss is placed too far because of where you entered. Now, a pro tip is if you see a break of structure done with 2 consecutive candles, then you have very strong momentum. This applies to anything trend related. So if you like, for instance here, you see that there's 2 consecutive candles before or even after that caused the second break of structure, or even the first. That is a great indicator of entering your trade, right? So first break of structure was done, the second, was done here by this candle, and then there was another candle followed right after it, indicating strong momentum. Now I'm going to jump on the chart now that I finally got it fixed, and I'm going to show you what I mean. Okay, here you can see that I've marked up a supply, and then I'm going here. Okay, so here is the first fractal break of structure, which we'll be using fractal lows and highs for our break of structure, or if you want to use major swing points, it's up to you, but generally fractals are better. So the first fractal break was here, price goes down, right, pulls back up, and then creates another fractal low. This is our second and then third fractal low. Price gets broken here by this candle. This is our second break of structure. You can enter on here as well, put our stop loss at this recent high if you want, and then target the next set of liquidity or whatever liquidity it is that you want to target. It's up to you, I don't care. Or you could always put it up here, or if you want, you can also enter, like I recommended on the market structure shifts, where you can enter at the fair value gap, right? Those same rules can still be applied on here if you want extra security on your trades. You don't have to, but it is something that you can do. Now, like I said, guys, nothing is fail proof. Anything that you do can lead to a loss. Anything can happen at the time of your trading. Don't be impatient. Don't get worried. Don't get scared. Don't start messing with your trading plan if things aren't working out. Okay, so with that being said, thank you guys for sticking to the end of this video. I hope it wasn't too long as the other one. I just wanted to give time to entry confirmation specifically. I hope that you learned something, and I hope to see you on the next one. And again, don't forget to join the Discord. I promise you're gonna love it. You're gonna get more support from me if you have any questions. And yeah, I'll see you guys in the next one. Peace.